Ladies and gentlemen, welcome to the SoFi Weekly Tuesday morning stream. Tevis, once again, is late, but Chris and myself could make it on time. And what a fantastic time to go live because SoFi has triple beat their earnings again. Um, I know some people thought that there was going to be some misses, that we weren't going to get, our normal amount of members, or we're going to miss on net income or something along these lines. But yet we broke past not only what SoFi said, but also what uh, Wall Street had said. Now, that doesn't mean that every single piece in this earnings results were good. We're going to talk about the good and the bad. Chris is extremely upset and unhappy. He is not happy with management, not one bit. I'm putting words in his mouth, but go ahead, Chris. How are you? You got no volume, brother. Nothing. Okay, I just set my cat down, then he jumped immediately back up. Okay, let's go through, and I'll bring up the earnings, and we can go through it together. Well, Chris fixes his thing.
Can you hear me now?
I got you, brother.
All right.
Welcome to the stream.
Thanks. I'm super upset.
Yeah. Are you upset with this 643,000 new members?
Yep. So disappointed. No, I think that I nailed that one. I think I guessed 640. So I think
Yeah.
that I won on that one. But no, overall, I echo what you said just in general about the earnings. So I think I'm pretty happy with them in general. There are a few things that I think are disappointing, but we'll get there. But yeah. Anyway.
So members, good ads, holding up that 40% growth rate, which continues to be a very hard challenge as we go forward. But still, I mean, haven't broke that streak yet. Products, 946,000 new products over the 12 million mark. Very cool. We'll go into breaking down what those individual products are. Now, Galileo, this is where the mixed bag starts. Tevis, brother, good to see you.
Hola. Sorry, hold on. Are we doing this setup?
I don't know. I'm going to go back to this the spreadsheet. You'll be fine.
Okay, are we live?
Oh,
we are.
We are live. Okay, cool. I'm going to be eating a little farmer's wrap while we do this, so I'm going to stay off camera for the first 5 minutes while I scarf this down, and then I'll give all my thoughts about everything.
Cool, man. So Galileo accounts, it actually grew pretty amazingly in terms of 7 million new accounts. That was definitely on the higher end for what I thought that it would be. So that's amazing. The problem is on the revenue side.
Yep.
I think it was pretty unanimous that we thought we were going to break 100 million, and we did not. In fact, it wasn't like 99 million or something like this. It was kind of stagnant growth.
Yeah, that's the most disappointing thing from the quarter for me, is the tech platform revenue and the stagnation there. And then the fact that the guidance for tech platform growth is expected to be mid to high teens versus 2023 levels, whereas previously they were saying 20% growth. So they are not seeing the growth in the tech platform that they expected, even at the beginning of the year. So that's that is by far the most disappointing thing in these results.
Right. Yeah, I didn't even catch the guidance part there. I was just too enamored by the 80% growth expected for financial services.
Yeah. No, that's super. Anyway, and this quarter they killed it in financial services.
So I actually know who made this slide, by the way. This was actually Chris Hager. Chris Hager put this slide in. Data-driven investing, the very own, put this slide in for everyone to help us understand. Chris, what did you think about them starting to
I'm so happy they put this in there, because this is one of the main things that people have been harping on, that SoFi skeptics have been harping on, is, hey, they never show us the vintage curves. We don't know what their losses are going to look like. They're being really opaque about what the the net charge-offs look like and the delinquencies and everything. And they put 2 complete slides talking specifically about that, which I loved, that show that, again, overall, they are all trending below the 7 to 8% losses that they've talked about. And I mean, they're a full percent underneath right now for the Q4 2022 vintage, right? So yeah, I don't think you can look at this graph and say that their 7 to 8% life of loan loss assumption is wrong.
Sure.
Unless we see something really, really strange. There is a bit of an uptick there. So like if you look at the slope of the purple pinkish line, I don't know what to call that, fuchsia versus gray, right? Right now it is trending up slightly more than the 6.07, but there's a large buffer inside there. I'm so glad they put this slide in there. It makes me very, very happy.
So we didn't go anywhere near the 6.7% expected for this quarter, at least.
Well, but this is different. So this isn't NCOs, which I actually haven't seen the net. So NCOs, for those
they
who
don't talk
haven't
about that a
listened or
lot. They
read
always
my
talk
other
about the
stuff,
life of it.
yeah, which makes sense, right? Because the reason they do that is because the net charge-offs can fluctuate from quarter to quarter a lot based on where you are and when you originated the loans that you have on the book.
Yeah,
So
I
it
mean,
actually does make sense to look at it in terms of life of loan losses.
you have room to talk about both, though. I mean,
Yeah, it's true.
Yeah, revenue, I think, beat almost everyone's expectations. I don't know anyone that thought we'd get anywhere near 600 million.
Yeah,
And adjusted EBITDA, 138, 137 million in that ballpark, which was also fantastic.
yeah, that's over. I think that's 18 million more than their guide, if I remember correctly. I think the midpoint of their guidance was 120
Oh, okay.
million
Right.
for adjusted EBITDA. Maybe I'm wrong on that. Let me look it up.
I think my expectations was
it was like
137 million. So it was like
115 to 125 was their range, and then for
So yeah,
revenue, I think it
120.
was 555 to 565, if I'm not mistaken.
Yep.
yeah, there you go, right here. And then net income expected at 5 to 10 million. What we saw, 17 million. And no sort of gap shenanigans or anything along those lines. We still accrued a lot of, corporate losses this quarter, 14 million, I think it was, or sorry,
Yeah.
this quarter.
Yeah. So
And
they're back to kind of normal on the corporate revenue side for now. Rates coming down will help that.
Tevis, your thoughts?
Yeah. So financial services growth really strong. The lending, I'd love to see it up. So that's great. I think in terms of the tech platform, like obviously that was the biggest disappointment out of all this. But what I will say is that, that's really like one client, probably like one big deal that they hope to land in Q2 that they probably didn't land, that makes or breaks that number in terms of a beat or a miss. Like that's how thin that margin is, especially after they said they're going to go after larger deal sizes that take longer ramp up times. And so, yeah, probably when they made their forecast in the beginning of the year, they said, okay, by Q2, we expect to land, 3 of these big deals. They might have landed one of the big deals. And as a result, they don't beat by as much, or the results don't look that good, or the growth rate doesn't look that good. But like, you have to measure it differently because the tech platform is the only segment that's business to business. And that really has some implications that come along with it. And so what I'm saying is it's not like missing members by 100K or something to that effect. It's like one deal and you either make it or you break it. And that could be a huge beat, or it could be a small beat, or it could be a huge miss, depending on how those deals that are in the pipeline go.
Right. Yeah, I mean, we'll have to see. Like I said, I think that a lot of people lean extremely heavily on Technisys, and I think that they look past financial services. And I think that everyone wants to say, "Oh, this is a bank." Well, banks make a crap ton of money, and if they're growing very fast, like who cares?
So I think people want to have their cake and eat it too, quite frankly, because when the tech platform is non-existent, they say this is a bank. And then, when the tech platform doesn't beat as much as they think it's going to beat, they're like, oh, see, I told you this was a bank. Well, let me flip that for you. if the lending segment actually came out and missed and the bank or the tech platform did fantastic, the reaction would be more to the downside.
Yeah, we would have missed.
Yeah, and people will find, like, if you're looking for a reason to hate on it, you will find it. It's so diverse and there's so many different segments of the business that every earnings result, you're absolutely going to find a reason. And so for me, if I'm putting all three segments out there and I'm saying, okay, you got to pick one that's got to miss, I'll probably pick the tech segment. Why? Because it's a small contribution to the revenue mix. Financial services growth is really the heart of the growth story, and the tech platform is more long dated in terms of when we expect that reward to eventually come. We're not expecting, everybody to migrate to the AWS of finance today or tomorrow. We're expecting that in 3 or 5 years. And so we have a longer runway for the tech platform, is what I'm saying. That, yeah, it's not great, but at the same time, when you compare it with everything else, it's like the least of all the evils that could possibly happen. At least that's how I see it.
So a couple things. Some people are saying, they only talk about total members, not active members. Half of these could already be gone. I'll fight back and say that they actually wrote off a lot of their members off their platform last quarter. So I don't believe that they're all inactive users. We can't see the full amount, but what we can see is the revenue per member and also the total member count, which is continuously going up. Okay. So whether you focus on, monthly actives or the total member count, the money is moving in one direction. Chris.
Yeah, if you look at average like financial services and lending revenue per user, it's almost flat over time. It is slightly coming down over time because there's always going to be a little bit of churn.
Well,
but the idea that like 50% of people on the platform are inactive is ridiculous when you look at the average revenue per user. Like
even that, I would say, is a really or not really bad way of looking at it, but that's a bad way of looking at it, because if you look at lending revenue per user, it's going up. And if you look at financial services revenue per user, it's going up. The combination of the both, it's going down because the
shift.
Here, I'll show you. There's a slide on it.
Yeah, because the shift because financial services makes less per member than revenue. Yeah, you're totally right.
2.7 times more. Now it's 6.2 times more. So because they make less, although both are going in the right direction, it is bringing the average revenue per user down.
Here's my PayPal. The one thing I know about PayPal that I'll add to this call. It's like looking just at take rate of PayPal without taking into account the Braintree's take rate versus
mix shift of revenue.
The mix shift of revenue makes a big difference, which is also why, by the way, if you look at, there's a slide lower down that talks about their NIM, the net interest margin.
Yeah, I think it's all the way down, right?
And you'll notice that it's actually down a little bit quarter over quarter. That's mostly a mix shift thing too. So they're moving more towards senior secured loans. If you look at the balance sheet, the point is they're going more towards a mix shift from personal loans to senior secured loans, which are a lower risk way to do personal loans. They package them off and sell them, so they only have a very small portion of the risk. But the net interest margin so the interest you get back is less because of that. And then also the shift is a little bit more towards student loans. So it's a similar story here.
The ratio also increased, did it not? The members to products this quarter, like it's above.
I can check right now.
Oh, that I didn't check.
Yeah, it went up. It's flat, 1.455 to 1.456.
Right. Okay.
So it's basically flat, but still, that's positive, right?
And you're seeing that across like that whole mix shift changing to lower, lower paying loans. You're also seeing like extremely high flying fintechs as well, like Nubank, for example, where they're going very heavy into secured lending right now, which is bringing down the average interest that they make on a per loan basis, but it's also much safer. Now, let's talk about this guidance for a second. I mean, we touched on it at the start, but this is crazy. 80%. I can't even model this. Like, this is crazy. How do we get here?
Yeah, that means an even faster acceleration from here. So we were like 26 million growth in financial services quarter over quarter. I don't know. I mean, I'm going to guess that the it seems like they should talk about that in the call. Hopefully that we get some commentary there, and hopefully we also get some commentary on the tech platform. I would like to see accountability, right? Like if it's not good, you should still talk about it. You should spend some time like being accountable for what went wrong, why expectations have been lowered, and that sort of thing. So I hope that they talk about that, right? I don't want them to focus the whole call on it because I also want the call to be upbeat and stuff. But I do want, I would like to see them discuss it in more detail. We'll see if that happens.
So the other thing,
just real quick, I just want to answer a couple house calls or house questions. So when is the call? It's at 8 o'clock. I've got it up on my other screen. Don't worry, we're not going to miss it. And PayPal thoughts. We're not talking about PayPal on this live stream. I'm probably going to be going into a direct one after this at 9 o'clock to re-listen to the call and do all my thoughts on that stock as well. But sorry, go ahead, Tevis.
You're also welcome to join Roy and I later tonight at Bootleg Weekly, 9 p.m., when we're going to talk about PayPal. But so just looking at this slide, what we know from the last quarters is that financial services was the only segment that didn't have an upper threshold in terms of their guidance. They said 75% plus, and they came in at 86% last quarter. And now they're saying 80% plus.
More than 80%.
Exactly, 80% plus. So it still doesn't have an upper threshold, right? The lending segment was 92 to 95. Now they're saying at least 95. I suspect that by the end of the year, we're going to be flat on the lending segment. Like it's not going to be 95 at all. It's going to be like what it did last year, basically. And now tech platform,
this is going to go up. Look at the origination. We'll talk about originations here in a second, but this I don't believe is going to stay the way it is.
Yeah, but like just look at what they're revising upwards. 92 to 95. Now they're saying at least 95. And now tech platform, they're saying mid to high teens, whereas before they were saying it was in the 20% range. So that's lower. So just something to keep in mind is even how they're talking about these segments, if you read between the lines, has hints in themselves.
Someone in the comments said deposits were light. I didn't see deposits. What were they at?
So deposits only went up by 1.4 billion, which is light. I actually think, so if you go down to, it's not.
That was like the yearly guidance for Wall Street, right? Going up by 1.4 billion.
Yeah, that's true. But if you look at, I think what happened, and I'll have to confirm this once we get more numbers. Like, again, I've only had about a half hour. I think what happened is they actually let a lot of time deposits expire. So there's 3 different types of deposits that SoFi has. There's demand deposits, which are checking, savings deposits, which is savings, and then time deposits, those are CDs. And so SoFi had a bunch of CDs out. It looks like it looks like they might have dropped about 1.5 billion worth of CDs. So like the average for this quarter was about 700 million less than the average for last quarter, which again, it makes sense that if you're increasing your savings deposits by a lot, that's cheaper than time deposits. And so I think, and I'm not sure, but I think a lot of it has to do with just them letting those CDs roll off, which actually makes sense to do it that way.
Right. Hey, I mean, I think that means that it's also stickier. I wonder what the rate that we were paying on the CDs versus the deposits. I'm sure they were very similar.
Actually, it was much higher. I have that. I'll look it up while you're.
Really, eh?
Yeah. I mean, not much higher. I think it was like, well, I'll just tell you in a second one day.
For normal institutions, I get why it would be higher, but SoFi pays such a high APY that I thought that it would be similar.
Well, they were putting out CDs when they were replacing warehouse lines of credit with them, right? And so there was a big, even going to time deposits was a pretty big difference. It was, so last quarter, the difference between the two was 50 basis points. So their average time deposit rate was 5.06%, whereas their savings rate was 4.54%.
Yeah. No, I mean, and how many deposits were in that?
Deposits were in time deposits. At the end of last quarter, it was 2.97 billion. No, that's the average. So the average for last quarter was 2.97 billion.
Yeah. And we don't have the...
We have the average again. It's in the press release. Let me find it again.
Oh, it is?
Yeah. Well,
all right, I'll find it.
Yeah. If you search for time deposit, so the average was 2.25 billion this time. So the average came down by $700 million. from quarter.
Man, financial services is going to look freaking amazing. Like, it's just going parabolic in terms of the growth.
It really is. We should talk about lending real quick.
Yes.
And originations especially.
Yeah. Bear with me while I bring up a little slide here for you guys. All right. Let's talk about a little originations, huh? Or
That
first,
is,
you don't see quarter over quarter. Okay, well, I'll show my spreadsheet after.
so they set a new all-time high for personal loan originations in Q2, which means, so the implications of this are that they are going back into lending. The implications of that are probably that they've received a lot of interest in their loans and they're leaning into rate cuts, right? So this is both a two-edged sword. So I actually think this is the right move. I think that in the current macro environment, like if you look at the other personal loan like Lending Club and Upstart and others, all the commentary has been really positive as far as the returns on personal loans and especially the demand for personal loans from people who are buying them. So this is actually really good for probably Lending Club, who's going to be reporting after the close today.
Yeah.
But it means that they're going back into lending. It probably means they're getting demand for their loans because they wouldn't have originated this much if they weren't seeing sales. And they haven't talked about sales in anything that I've seen here. Maybe I missed it somewhere, but they always talk about it in the call. So we'll get that commentary in the call. But that is a lot of personal loans.
Don't forget about home loans. It's kind of cool as well.
Yeah, the home loans are going up too, right? Which that's pretty capital light. They sell those within a quarter of originating them. The other, I guess, the two-edged sword. So I think it's good from a growth perspective. It's good I like it. I think it's the right move. What is not good is, especially combined with the fact that the tech platform didn't grow this quarter, it's going to reinforce the narrative. And it's not just a narrative at this point, right? Like a significant part of the growth of this company is coming from the bank side. I do think that they aren't like, still the growth that they're seeing there is massive and ridiculous. And I don't care as much I would prefer that there was growth in both segments, right? But this is going to reinforce the story, and it actually is backed up by the data that the fact that at this point, like the growth driver is going to be the lending segment and the financial services segment until they prove something different, right? The tech platform is still, we don't have enough visibility into it. And as of right now, it's not showing the growth in order to give it a really big multiple for that part of the business.
Yeah, I mean, one thing that I think is important to note, though, well, two things. One, this is going to strengthen the bear case. They're going to go heavy on this because they're going to say, hey, where SoFi failed, they're filling the gaps with this essentially unlimited tap of demand for personal loans that they can tap into. It's just whether or not that, it's the right move or not. No one has that answer until later on. But another one in terms of the technology platform, if you want to be really forward looking, look at the accounts. The accounts did grow very well. That comes before the revenue. So we could see it. The fact that they lowered their guidance is never good. But like I said, I'm here for financial services. I think that is just a segment that everyone is blowing past right now because the margins aren't as high as they used to be, especially whenever it was a loss leader. Like people were just not looking at that segment. Now it has nearly a higher contribution margin than the tech platform. It came in at like 31.5%. Like that's in 3 quarters. It went from going profitable to 3%, 14%, 23%, 31.5%. Like it's just unbelievable. I'm choking on my own ideas here. But yeah. I'm going to bring up my spreadsheet here, but this is what we're going to talk about next is products. Call is at 8:00, by the way. So let me just bring this up. Perfect. So this will all just give us a better idea of how they're growing instead of just looking at. Wait, I gotta close so many things. Instead of just looking at the year-over-year numbers, let's see how they've actually been doing across some sort of period here. So members just a year ago was at 6.2 million, all the way up to 8.7 million. Okay. You can see the product counts here, products per member, which yes, did essentially go positive, but it's flat.
So if you just scroll a little bit to the left, Tanner, I mean, yes, products per member is flat, but look at the trend. The last time we saw an uptick in products per member was Q1 2023, over a year ago.
Okay. Sure. Yeah.
Like it's just,
it's an inflection point, right?
Even if it's flattening out, that's like a 4 or 5 quarter trend downwards that it's flattening out from, which is still great to see, right? Because they're putting up great member counts.
Right. These are for the full segments: lending, financial services, tech platform. This is how much we're bringing in. And then the corresponding amount of accounts that we're also bringing in there. So, 3 million here, 7 million, 8 million, 5 million, 7.4 million again. Personal loans. Look at this ramp though, back up to nearly 70,000 new personal loans, home loans. We haven't seen these numbers since they fricking got rid of their, old partner back in Q4 2021. So that one is seemingly ticking up, and I think HELOCs will also be counted there as well. So we'll probably see the average loan balance per home loan end up going down, but the amount of products going up, and overall originations should continue to climb. And that's before rate cuts.
So if you just look at, sorry, I'm going back to deposits really quick. If you just look at the averages between the 2 quarters, and you look at demand, so savings deposits between the 2 quarters went up 3.2 billion on average. Demand deposits, which is checking, went down about 300 million. So it looks like overall, like deposits that are what we typically call so demand and savings. So the things that people are putting into their checking and savings accounts went up about 2.9 billion. Again, I'm rounding here because I'm doing the math in my head. And so it seems to me like the bulk of it was probably just a bunch of time deposits expiring. So a bunch of CDs hitting their limit, and SoFi just didn't sell more CDs.
Money bringing in still a ton of new accounts, over 400,000. Invest actually ticked up. So we saw this little bleed out, I think, of them getting rid of old accounts that were inactive. Okay. Now we're starting to tick back up an additional 100,000 new members. Now, we don't know that these are all active accounts. I'm going to assume something along those lines, though, that this was a little bit inflated back here in Q3 of 2023 with some accounts that just simply have moved to other institutions. Over here, I think this is actually more genuine to the real number. Included, I have all these different stats that you guys can follow in terms of the percentage of new accounts, percentage of total, percentage of new products, percentage of total products, so you can see where we're growing, right? Credit cards, really surprising, only 6,000 here. They just completely, they're talking one side about how they're going to ramp this aggressively in 2024, and then whenever we look at the new credit card products, just not there. So I can't wait to hear the call, to hear what they say in terms of them ramping that.
Is the call?
Well, I don't think you have to wait for the call because it's right now.
I still have music. I'll refresh, but yeah, still very much music playing. But yeah, we're ready to go. Anything that you guys want to hear in particular, Chris?
I wanted there's lots of stuff I want to hear, but actually a lot of it was answered. So mostly it's about the tech platform, right? I want to hear commentary on what they're seeing and why they aren't seeing the success that they prognosticated. I also want to see, I'm sure they'll reiterate their 2026 guidance, which I also want to see. Tevis, do you have anything you're looking for?
How the hell they're going to do 80% plus on financial services, and they cannot give the same answer of here's the same products.
Thank you for your patience.
Oh, no. Sorry. They said a few minutes time. I'll continue to monitor it, but I'm not playing the music for you guys. Sorry. Ken Megan says, we want Derek White. Little chant outside the SoFi offices. New product offerings would be nice. Yeah, I mean, it doesn't look like they released any sort of new products. They would have done that with the press release. Probably not more specifically on the call. They might touch up on if they've migrated over to Technisys or what that means for cost savings. But
actually, on that note, in the past, when they've released securitizations, they mentioned it on the call without the press release being out. And then the press release came out several hours later. And then Anthony Noto touched on it in interviews with CNBC and others. So I'm still hopeful. Fingers crossed.
We need Wyndham Clark to make a cut. Yeah, so 3.0 was the update that SoFi just recently did to their app. So in the 8+ years that it's been on the iOS store, it's gone from version 1.0 to 2.0. And then as of 4 days ago or something like this, they updated to 3.0 or, the first time in company history. So everyone's a little bit curious on what that could mean. What it does mean is some sort of major update on the back end or something that they could have ready to be launched. We just don't know quite yet. SoFi will probably tank down 17%. I mean, the market can move how the market's going to move. It's not a perfect quarter in terms of no bear cases. This is the thing with lending.
So this is a better quarter than last quarter, and even last quarter it only tanked like 10%. I don't think 17's on the cards.
24 earnings conference call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question during this time, simply press star followed by 1 on your telephone keypad. If you wish to withdraw your question, please press star followed by 2. Thank you. With that, you may begin your conference.
Thank you, and good morning. Welcome to SoFi's second quarter of 2024 earnings conference call. Joining me today to talk about our results and recent events are Anthony Noto, CEO, and Chris Lapointe, CFO. You can find the presentation accompanying our earnings release on the Investor Relations section of our website. Our remarks today will include forward-looking statements that are based on our current expectations and forecasts and involve risks and uncertainties. These statements include, but are not limited to, our competitive advantage and strategy, macroeconomic conditions and outlook, future products and services, and future business and financial performance. Our actual results may differ materially from those contemplated by these forward-looking statements. Factors that could cause these results to differ materially are described in today's press release and our subsequent filings made with the SEC, including our upcoming Form 10-Q. Any forward-looking statements that we make on this call are based on assumptions as of today. We undertake no obligation to update these statements as a result of new information or future events. And now, I'd like to turn the call over to Anthony.
Thank you, and good morning, everyone. Our second quarter results were exceptional and continue to demonstrate SoFi's leadership as a one-stop shop for digital financial services and the amazing grit of our team. I'll cover 5 topics before turning to Chris for a deeper look at our financial and operating performance. First, our strategy continues to drive strong, diversified growth, profitability, and returns. Second, our continuous product innovation and brand building are fueling significant member and product growth, which are key to our long-term revenue and profit growth outlooks. Third, turning to our segment results, our financial services segment demonstrates our clear structural advantages in delivering value to members. Fourth, Our leadership and agility in lending has generated sustained returns despite rising rates and positions us to move quickly once rates come down. And finally, our tech platform is making good progress on its journey toward becoming the AWS of not only fintech, but of financial services broadly. Turning to the first topic, the success of our one-stop shop strategy. For Q2, adjusted net revenue reached a new record of $597 million, a 22% year-over-year increase. Our rapid diversification made a record revenue quarter possible, even with just 5% growth in adjusted net revenue in lending. Combined, financial services and tech platform revenue grew 46% year-over-year and now makes up 45% of total adjusted net revenue, up from 38% 1 year ago. To put that accomplishment in context, lending now stands at just 57% of adjusted net revenue, compared to 99% of our revenue when I joined nearly 7 years ago, and more than 70% of revenue just 2 years ago. We also delivered even greater growth and profitability in the quarter. EBITDA grew 80% year-over-year to $138 million. We recorded our third consecutive quarter of GAAP profitability, with $17 million in GAAP net income versus a loss of $40 million in Q2 of 2023. Credit performance was better than expected as cumulative fair value adjustments from delinquent loans peaked in March, along with delinquencies on an absolute and percentage basis. We are really encouraged by our team's ability to bend the curves through stringent underwriting, limiting credit exposure when prudent, and improving collections and servicing. Chris will share details on the performance of our recent personal loan vintages, which show clear improvements versus older vintages, underscoring our confidence in our prior guidance around life of loan losses peaking in the 7 to 8% range. Our loan sales continue to scale at attractive execution levels with an increasingly diversified set of buyers, with $1.6 billion in total sales this quarter and $4.7 billion in the 3 trailing quarters. This brings me to my second topic. Our rapid pace of innovation and brand building are fueling significant member and product growth. The growing size of our member base and the number of products they use impact the results we're reporting today. But more importantly, they are the leading indicators of our potential revenue growth and profitability in the future. In Q2, we added 643,000 members and now have 8.8 million in total. That's up 41% year-over-year. We grew products in the quarter by 946,000 to 12.8 million in total. That's up 43% year-over-year, adjusting for our exit from crypto last year. Nearly 40% of all new products in Q2 were opened by existing SoFi members. We also see that nearly 30% of new members open a second product in the first 30 days, demonstrating the immediate value of our one-stop shop strategy. We've doubled our member base and number of products in the past 2 years, and Q2 was the 20th consecutive quarter of greater than 30% growth. Our growth in members and products will drive our financial growth for years to come, and is the basis for our 3-year financial outlook shared at the end of 2023. All this growth is a direct result of our relentless focus on innovation. Because we offer products across 8 categories, compared to many fintechs that only offer 1 or 2, the magnitude of our innovation is not always obvious. As much as I'd love to share the full breadth of what we shipped in the quarter, I'll just cover a few of the highlights. I'll start with our financial services business, which drove 91% of our new product adds in the quarter. Our invest offering is getting better every day. In fact, I don't know of any other self-directed product that offers alternative assets like private credit, private real estate, and private venture investing side by side with fractional shares, robo-funds, ETFs, and IPOs. Our innovations over the last year are starting to accelerate results, driving a 58% year-over-year increase in assets under management in our invest business in Q2. And this was driven largely by net flows. We fully rolled out alternative assets and mutual funds, including interval funds from well-known financial leaders in KKR, Carlyle, Franklin Templeton, and ARK Venture Fund, which includes several leading private technology companies. Alternative assets generated 12% of all net flows during the second quarter. We brought the concept of one-click checkout to individual asset transfers, enabling our members to consolidate their assets the way they would like, and now we're seeing benefits from that innovation as well. We are now finalizing a turnkey way for companies going public to extend participation in their IPOs at scale to their customers, employees, and partners. With this new directed share program, people can open an account, enter an order, and fund it in minutes without fees, minimum balances, or speaking to anyone in order to participate in an IPO. Turning to SoFi Money, in the quarter, we launched Zelle, one of our most requested features and one element of our much larger money movement product pipeline. The innovations in our member business unit, which focuses on ensuring our products work better when used together, are reaching critical mass. For example, 3 million members have signed up for SoFi's broad-based rewards program. We're creating a rewards economy across our products, including rewards for using our app and other services, and we're expanding redemption options, including into stocks, cash for savings, and travel. For SoFi Plus, we achieved 1 million members. For people that are not familiar with SoFi Plus, it is our premium membership tier available to those who enable direct deposit. SoFi Plus includes our highest APY on banking balances, which today is up to 4.6%. It also includes up to 2x reward points, up to 3.3% cashback rewards on SoFi credit spending, discounts on personal loan rates, and much more. And I'm very excited to share that we've laid the foundation to provide more value in SoFi Plus, not only to direct deposit members, but also a monthly paid subscription product for those who prefer that option over direct deposit. We intend to test this new subscription-based option for SoFi Plus later this year. We're also driving iteration and learning to drive innovation in credit cards. We improved our acquisition capabilities and introduced a 10% cashback boost for SoFi Plus members that has shown positive results. And I'm excited to share that this week we'll also begin testing 2 new credit cards to better serve our members' needs. One card for cashback rewards on everyday high-spending categories, and one for members who need a no-frills card with no surprise fees. Turning to lending, we've launched new capabilities that position us for future growth, especially as the rate environment improves. In small and medium business, members can now apply for a loan at SoFi and get approved offers from lending partners. In home loans, we can now close our home equity products instead of brokering them out. This dramatically increases our potential for revenue per loan. Notably, we're now a principal in home equity loans and can offer members a lower cost of borrowing in these secured loans compared to higher rates in unsecured lending. And of course, our tech platform is a center of innovation as we add capabilities to our already comprehensive offering. We expanded our buy now, pay later product for post-purchase use. We added new wire capabilities and extended the AI-driven transactional fraud capabilities in our payment risk platform to non-processing partners. We also advanced the quality of our managed service in the cloud and introduced 3DS, which adds another layer of security to digital card transactions. These improvements ensure our modern, cloud-based platform will continue to serve the needs of brands, fintechs, and global financial institutions alike. Having world-class products is a necessary factor in becoming a top 10 financial institution, but it's not enough. We must also become a trusted household brand name. We measure this by our unaided brand awareness. Our world-class marketing team stands in a category of 1. Their amazing work has increased unaided brand awareness to the 7 to 9% range, which is up about 40% year over year and 4x since 2021. Our brand punches way above its weight as our team continues to make its footprint bigger than its foot. Now diving into our segment results. In financial services segment, we are seeing the continued benefits of structural advantages that drive our leading value proposition. We reported record segment revenue of $176 million, up 80% from $98 million in the year-ago quarter. Importantly, this drove contribution profit of $55 million compared to a loss of $4 million 1 year earlier. Financial services products grew $865,000 in the quarter, up 48% year over year, adjusting for our exit from crypto last year. Revenue per product grew 8% quarter over quarter and 29% year over year. We believe there's substantial upside to the monetization of our financial services products. SoFi Money achieved new records this quarter as ending deposits totaled $23 billion, with consumer deposits up $2.2 billion from the previous quarter. Account openings grew by 419,000, and 90% of our deposits remain tied to sticky direct deposit relationships. Debit spend also continues to increase at a rapid pace, up 129% year over year, and now annualizing at about $9 billion. Our credit card and invest businesses remain in investment mode with nearly $100 million in annualized losses, but we expect them to follow a similar path to Money in achieving variable profit and contribution profit. In our credit card business, delinquency entry rates and roll rates improved by roughly 20% apiece from 2023 averages. Turning now to my fourth topic, our strong leadership across lending. We reported strong results despite our conservative posture, given a 500 basis point increase in benchmark rates over the past 2 years and continued macro uncertainty. Importantly, net interest income reached an all-time high of $279 million, or 82% of lending revenue, versus 72% 1 year ago and 45% 2 years ago. Net interest income is cash revenue. Let me say that again. Net interest income is cash revenue, so 82% of our lending revenue is cash. Notably, discount rates and spreads were largely unchanged and in aggregate had a slight negative impact on lending revenue. Our personal loan originations reached a record of $4.2 billion while sticking to stringent underwriting standards as our team demonstrated its grit by consistently iterating on pricing and marketing throughout the quarter. Our home loan originations were their highest since Q1 of 2022, growing 24% quarter over quarter and 71% year over year, despite interest rates at their highest level in 10 quarters. On top of that, purchase home loan volume was our highest ever, growing 25% from Q1 2024 and nearly 100% year over year. Once rates come down, we expect to benefit from our expansion into 3 products in home lending: purchase loans, home equity loans, and the volume already generated by our financing business. Student loan originations grew 86% year over year. The team drove our strongest Q2 of origination volume in 3 years by iterating to drive continuous improvement throughout the quarter and into Q3 with private loan refinancing, which exemplifies our ability to respond to environmental factors to drive results. And my fifth topic, the tech platform segment is making good progress on its journey to become not only the AWS of fintech, but of financial services more broadly. We recorded segment revenue of $95 million, up 9% year over year, and contribution profit of $31 million, up 82% year over year at a 33% margin. This represents our 4th consecutive quarter of over 30% margin. Our customer wins have been more diverse, including but not limited to secure card and B2B partners. Our pipeline of interest remains robust and includes U.S. and international financial institutions, along with major consumer and commercial brands. As we have noted, we are pursuing enterprise partnerships with larger existing customer bases for more durable revenue opportunities. These partnerships take multiple quarters, not months, to win, and have even longer integration cycles due to their size and complexity. In closing, the quarter was exceptional. We continue to demonstrate a record of strong, diversified growth, even in uncertain times. The performance of our leaders and the grittiness of our team was the best I've seen in my 7 years here. Suffice it to say, I cannot wait to see what we achieve in a better climate. Combining our high member growth and product innovation with lower benchmark rates, unemployment at 4 to 5%, stable inflation, and a stable economy, I could not be more confident in our ability to achieve our ambitions. With that, I'll turn it over to Chris for a deeper look at the results.
Thanks, Anthony. The second quarter was underscored by continued execution, profitability, and increased diversification. Strong evidence of how our differentiated business model drives SoFi's durability and long-term growth potential. I'm going to walk through key financial highlights and our financial outlook. Unless otherwise stated, I'll be referring to adjusted results for the second quarter of 2024 versus second quarter of 2023. Our GAAP consolidated income statement and all reconciliations can be found in today's earnings release and the subsequent 10-Q filing, which will be made available next month. For the quarter, we delivered record adjusted net revenue of $597 million, which grew 22% year over year. Adjusted EBITDA was $138 million at a 23% margin. This represented over 7 points of year-over-year margin improvement, demonstrating significant operating leverage. In fact, sales and marketing declined as a percentage of adjusted net revenue by 6 points relative to the year-ago quarter. We delivered our third quarter of GAAP profitability, with GAAP net income reaching $17.4 million, a $65 million improvement year over year, and GAAP EPS of 1 cent per share. Now on to the segment-level performance. In lending, we achieved adjusted net revenue of $339 million, with $198 million of contribution profit at a 58% margin. These results were driven by 20% year-over-year growth in net interest income, while non-interest income was down 38% as planned. Growth in net interest income was driven by a 40% year-over-year increase in average interest earning assets and a 27 basis point year-over-year increase in average yields. This resulted in an average net interest margin of 5.83% for the quarter, up 9 basis points year over year. In terms of non-interest income, Q2 originations grew 22% year over year to $5.3 billion and were driven by a record quarter in personal loan originations, which grew 12% year over year and 28% sequentially to $4.2 billion. Our student loans business saw origination volume grow 86% year over year, with a slight 2% decline sequentially to $737 million. Home loans grew by 71% year over year and 24% sequentially to $417 million. Our personal loan borrowers' weighted average income is $168,000, with a weighted average FICO score of 747. Our student loan borrowers' weighted average income is $137,000, with a weighted average FICO score of 764. In the second quarter, we sold portions of our personal loan and home loan portfolios totaling nearly $1.6 billion. In terms of the personal loan sales, we closed $1.1 billion of principal at a blended execution of 106.2%. These sales had similar structures to other recent personal loan sales, with cash proceeds in line with par or at a small premium to par, with the majority of the execution premium consisting of a contractual servicing fee that is capitalized. These deals included a small loss share provision that is above our base assumption of losses and immaterial relative to the exposure we would otherwise have if we held the loans. Our $381 million of home loan sales were sold at a blended execution of 101.9%. Additionally, we sold $69 million of late-stage delinquent personal loans in the quarter. We noted last quarter that we typically have not sold delinquent loans until such time that they are charged off. However, we've been able to generate positive incremental value in these sales relative to selling after they charge off, both from our improved recovery capabilities and by maintaining servicing. Finally, we executed $989 million of senior secured financing, which will show up on our detailed balance sheet as senior secured loans held for investment at amortized cost. These loans have a fixed-term structure and are secured against the underlying assets, therefore equivalent to investment-grade bonds if you were to do a securitization for the same pool of collateral. In addition, these loans are priced at market rates, which not only helps to diversify our balance sheet, but also provides an additional return above our cost of funding and a yield similar to the net interest margin of our loans, which are unsecured. Turning to credit performance, our on-balance sheet 90-day personal loan delinquency rate was 64 basis points in the quarter, a decrease from 72 basis points in Q1, which is evidence of surpassing a peak. Our personal loan annualized charge-off rate increased to 3.84% from 3.45% in Q1 2024, including the impact of asset sales, new originations, and the delinquency sale in the quarter. Had we not sold these late-stage delinquencies, we estimate that including recoveries between 90 and 120 days delinquent, we would have had an all-in annualized net charge-off for personal loans of approximately 5.4%. For our student loans, our on-balance sheet 90-day delinquency rate was 12 basis points versus 13 basis points last quarter, while our annualized loan charge-off rate was 64 basis points. That brings me to an important point, an in-depth look at cumulative net losses on several of our personal loan vintages and how this underscores comfort in our 7 to 8% maximum life of loan loss assumptions in line with our underwriting tolerance. As you can see on page 8 of our investor presentation, a loan vintage analysis indicates the following. Using our 2017 vintage as a starting point, as this is the last that approached 8% life of loan losses at 7.85%, you can see significant improvement in cumulative net losses at a given percentage of remaining unpaid principal for more recent 2022 and 2023 vintages. Specifically looking at the Q4 2022 vintage, soon after we made material cuts to credit, at roughly 40% of remaining unpaid principal, net cumulative losses of 5.02% are well below the 6.07% observed in the 2017 vintage at that same point of 40% remaining principal balance. In addition, you can see that more recent vintages are performing as well or better than the Q4 2022 loans at similar levels of remaining unpaid principal. This is critically important as this analysis and comparison gives us confidence that our loans will continue to perform in line to better than our tolerance. Furthermore, looking at page 9 in the investor presentation, you will notice that only 44% of unpaid principal remains from our Q1 2020 through Q1 2024 originations. Among the 56% of principal that has already been paid down, we've seen only 3% in net cumulative losses. For life of loan losses on this entire cohort of loans to reach 8% net cumulative losses, the remaining unpaid principal would need to charge off at a rate of 11%. Past vintages have performed meaningfully better after this point in the seasoning curve, further improving our confidence in achieving loss rates below 8%. Now turning to our fair value marks and key assumptions. Our personal loans are marked at 104.3%, 5 basis points higher quarter over quarter, with a negligible change in the discount rate. For our student loan portfolio, the fair value mark decreased by 17 basis points to 103.6%, while the discount rate rose by 10 basis points to 4.44% due to rising rates and a wider spread. Overall, sequential changes in spreads and discount rates had a negative impact on reported revenue. Moving on to financial services, where net revenue of $176 million increased 80% year over year, with new all-time high revenue for SoFi Money and our loan platform business, as well as continued contributions from SoFi Invest and credit card. Overall monetization continues to improve, with annualized revenue per product of $64, up nearly 29% year over year versus $50 in Q2 2023. This is driven by higher deposits and member spending levels in SoFi Money, greater assets under management and monetizable features in SoFi Invest, and robust growth within SoFi credit card spend. Net interest income of $139 million increased 87% year over year, which was primarily driven by growth in consumer deposits. Importantly, non-interest income grew 58% to $37 million in the quarter, which represents approximately $150 million in annualized revenue. This was driven by interchange growth of 67% year over year as a result of over $10 billion in total annualized spend, as well as our referrals from our loan platform business, which grew 66% versus the prior year period. Contribution profit reached $55 million at a 31% margin for the quarter, even as we continue to invest in innovation and new opportunities to rapidly grow this operating segment with attractive returns. Lastly, we reached 11 million financial services products in the quarter, which is up 39% year over year, with 865,000 new products in the quarter. We reached nearly 4.3 million products in SoFi Money, 2.3 million in SoFi Invest, and 3.9 million in Relay. Shifting to our tech platform segment, where we delivered net revenue of $95 million in the quarter, up 9% year over year and 1% sequentially. Revenue growth was driven by strong performance from new clients onboarded over the last 4 quarters, along with strong monetization of existing clients on our platform. Galileo accounts grew 23% year over year to 158 million. The segment delivered a contribution profit of $31 million, representing a 33% margin. We continue to leverage investments made in the segment as we continue to position Tech Platform for higher rates of diversified, durable growth going forward. As mentioned earlier, a strong pipeline of interest spans financial institutions along with major consumer and commercial brands, representing larger and more durable revenue opportunities and with longer sales and integration cycles due to the size and complexity. Shifting to our balance sheet, where we remain very well capitalized. Assets grew by $1.3 billion as a result of $2.1 billion of growth in loans and approximately $800 million decrease in cash equivalents, and investment securities. On the liability side, member deposits grew by $2.2 billion to $21 billion, while overall deposits increased to $23 billion. We also reduced our brokered deposits by $800 million as we continue to use our consumer deposits to replace higher cost parts of the funding stack, and we exited the quarter with $1.1 billion of warehouse debt drawn. Currently, there's a 213 basis point difference between the interest we pay on deposits and the interest we pay on warehouse lines, which translates to about $500 million in annualized interest expense savings, given the size of our deposit base. This difference also continues to support our net interest margin, underscoring the benefits of having the option of holding loans on balance sheet when advantageous and collecting net interest income. Overall, we expect to maintain a healthy net interest margin above 5% for the foreseeable future and benefit from the continued mix toward deposit funding, along with our ability to sustain healthy deposit versus lending betas. In terms of our regulatory capital ratios, our total capital ratio of 16.8% decreased by approximately 50 basis points from 17.3% last quarter and remains comfortably above the regulatory minimum of 10.5%. Lastly, we grew book value to $5.9 billion and tangible book value by $92 million sequentially to $4.2 billion, with tangible book value per share at $3.92. Now on to guidance. Throughout the last 12 months, we have demonstrated the benefit of having a diversified, high-growth set of revenue streams, multiple cost-efficient sources of capital, a keen focus on underwriting high-quality credit, and a high degree of operating leverage as we scale the business. We expect those benefits to persist even in light of the macro backdrop. For Q3, we expect to deliver adjusted net revenue of $625 to $645 million, adjusted EBITDA of $160 to $165 million, GAAP net income of $40 to $45 million, and EPS of 4 cents per share. For the full year 2024, we now expect to deliver adjusted net revenue of $2.425 to $2.465 billion, which is $35 million higher than our prior guidance range of $2.39 to $2.43 billion. This implies 17 to 19% annual growth versus 15 to 17% previously. This guidance now assumes lending revenue will be at least 95% of 2023 levels. Financial services will grow more than 80% year over year, and Tech Platform will grow mid to upper teens % year over year. While this is lower than our original 20% guidance for Tech Platform, we view this as transitory and still feel confident in our multi-year growth guidance for this business. We now expect to deliver adjusted EBITDA of $605 to $615 million, above our prior guidance of $590 to $600 million. This represents a 25% adjusted EBITDA margin. We now expect full-year GAAP net income of $175 to $185 million, above prior guidance of $165 to $175 million, and GAAP EPS of 9 to 10 cents per share, above prior guidance of 8 to 9 cents per share. We continue to expect growth in tangible book value of approximately $800 million to $1 billion and continue to expect to end the year with a total capital ratio north of 16%. We continue to expect to add at least 2.3 million new members in 2024, which represents 30% growth. Overall, we couldn't be more proud of our Q2 results. Having delivered $597 million of adjusted net revenue and $138 million of adjusted EBITDA, we continue to make great progress against our long-term growth objectives and remain very well capitalized to continue to pursue our ultimate goal of making SoFi a top financial institution. With that, let's begin the Q&A.
At this time, I would like to remind everyone that in order to ask a question, please press star followed by the number 1 on your telephone keypad. Please keep in mind we'll take only one question per person at a time. Please rejoin the queue for any additional questions. And the first question comes from John Hecht from Jefferies. John, your line is open. Please go ahead.
Morning, guys, and thanks for taking my questions, and appreciate all the incremental disclosure in the deck. The question is, I think you said that cumulative losses would have to go above 10%, I think to 11%, for you to kind of breach your 8% assumptions in your underwriting. What kind of scenario would that entail, in terms of like payment rates or delinquency rates, and just to kind of connect the dots there?
Yeah, sure, John. Thanks for the question. So like we said, credit's performing in line with expectations, and we remain extremely confident in our 7 to 8% life of loan loss assumption. Just to reiterate what I had mentioned in my prepared remarks, when looking at all originations from 2020 through Q1 of 2024, only 44% of those remain. Of the 56% that got paid down, we've experienced only 3% net cumulative losses. So in order to reach 8% cumulative losses on the entire pool, the remaining 44% we would need to charge off at 11%. So from where I sit, something would have to materially change in order to hit 8%, as prior vintages with similar levels of remaining UPB have never experienced losses even close to 11%. In addition to that, we ended up showing you vintage analyses that highlight how recent vintages, since making our credit cuts back in the second half of 2022, are performing materially better than the 2017 cohort, which was the last one to come even close to 8%. Furthermore, what gives us even more confidence is that the leading indicator for losses, which are our delinquencies, have started to turn the corner, and we're really bending the curve. So in our personal loans business, we ended up surpassing a peak in Q1 on not only dollar principal, but also cumulative fair value adjustments and percentage UPB. So from a dollar principal perspective, we ended up having $96 million of 90 to 120-day delinquencies in the quarter versus 103 back in Q1. From a percentage UPB basis, those were at 64 basis points in the quarter versus 72 basis points in Q1. And then from a cumulative fair value adjustment basis, that was $79 million in Q2 versus $88 million in Q1. And what's even more important than that, these trends are continuing throughout the first several weeks of Q3.
The next question comes from Terry Ma from Barclays. Terry, your line is open. Please go ahead.
Hi, thank you. Good morning. So you show some pretty encouraging vintage charge-off metrics in slides 8 and 9. And it sounds like from your commentary, everything's kind of in line. But maybe just kind of reconcile your more conservative stance and maybe talk about what you need to see in the environment to maybe just grow a little bit again in the portfolio.
Thank you for the question. We're really encouraged by the trends we're seeing in credit, as Chris mentioned. We're really proud of the fact that we're able to achieve record revenue with 22% year-over-year growth, with lending barely growing. I would say the areas of incremental opportunity as we go into the back half of the year: home loans, really proud to see the growth rate year-over-year in home loans. Student loan refinancing, also a product that shouldn't be doing really well in this interest rate environment, also had strong growth. On the personal loan side, we're going to stay relatively conservative compared to our balance sheet ending assets there, primarily because we want to see how the year trends in terms of unemployment. There's a big number coming out on Friday. We're at 4.1%. A move to 4.2% could signal a recession. And so while there have been improvements, we're not changing our stance. We're able to achieve pretty strong growth year-over-year without getting too aggressive on the personal loan side. There are factors that could cause us to originate a lot more in personal loans. I will tell you, I see more near-term opportunity in home loans and student loan refinancing. But in personal loans, the thing that would cause us to be more aggressive in terms of the growth rate is if we have greater than expected sales. In addition to that, changes in benchmark rates. In addition to that, continued improvement in our credit trends if they start to accelerate better than we've already seen, which is quite positive. But all in all, we have a lot more growth. We could grow much faster if we wanted to, but we want to drive durable, diversified growth. And that was the reason why we took a stance in limiting our personal loan balances specifically. The other thing that could drive growth, which would be further diversification of the balance sheet, is home equity loans. We're now doing home equity loans as a principal as opposed to an agent. They're obviously secured lending and attractive rates, more attractive than personal loan rates. So there'll be a greater emphasis on that. That could also drive better performance there. So a lot of opportunities as it relates to the lending business. We're taking a pretty conservative view purposely. I quite frankly don't feel like we're getting paid for the results we're delivering, so I'm not sure why we'd be overly aggressive at this point.
The next question is from Dan Dolev at Mizuho. Dan, please go ahead. Your line is open.
Hey guys, great results here. Really appreciate letting us asking a question. So, how are you, Anthony, Chris, how do you expect to keep growing financial services? I mean, obviously you've grown deposits so much. How do you expect to grow it given that you've grown interest income now? If you can talk a little bit about the near-term future. Thank you.
Thanks, Dan. Well, first, we did a really incredible job driving the diversification. The only way we're able to achieve record revenue is because our financial services segment had a record at $176 million, up 80% year over year. It was driven by product growth, as you know, up 47%. It was also driven by deposits up 80%. That drives the net interest income. I think more interestingly is the growth opportunity we have in non-net interest income. We reported $37 million in that line item. It grew very nicely, 58% year over year. If you annualize the number, it's about $150 million. And there's a couple of drivers of that. First, continue to drive increased product growth. We had 47% growth in financial services products. That will be one driver of strong growth. The second is increased monetization or revenue per product. We saw strong growth in revenue per product in the mid-20s as well. What drives it going forward from here? Interchange was up 67% year over year. AUM was up 58% year over year. We'll see benefits in brokerage, not just from AUM growth, but also increased monetization for a dollar of AUM, which is about half what we think the benchmark rate is. Continue driving home, auto, and life insurance, which we call SoFi Protect, and then our loan platform business. So it's a combination of those different monetization vehicles that will drive continued revenue per product, which we think has a significant upside after growing 29% already in this quarter. And then our product growth is something that's probably a lot more visible to everyone, which is up 47%. So dual-pronged growth dual-pronged dimensions of growth should continue to drive increased diversification there.
The next question comes from Kyle Peterson from Needham & Company. Kyle, your line is open. Please go ahead.
Great. Thanks, guys. Good morning. Thanks for taking the questions. Wanted to touch on deposits. Obviously, continue to see nice growth in the core base here with members. But how should we think about the growth outlook for deposits and kind of how that counterbalances with any ongoing runoff of some of the brokered funding?
Yeah, I'll let Chris talk about the sort of specific trends in the quarter. But as it relates to the broader macro picture, we're obviously entering an environment where rates are likely to go down in the future. And many people ask us, will you maintain a high rate? And the answer is we will maintain a high rate relative to our competition. We think we have a competitive advantage, given that we have such a big origination platform. The origination platform allows us to fund a higher APY than a lot of other competitors that don't have an origination platform. So the two businesses work in tandem. As rates go down, the value of our loans generally go up, all else equal. And so we can maintain a superior APY. That doesn't mean we may not change it. It just means it will be superior to drive our differentiated value proposition and leverage our competitive advantage. As it relates to deposits, more specifically, rate is one element of our differentiation. The other elements of differentiation start with no fees. We do not charge. We don't require minimum balances to get our services. You do get a higher APY if you do direct deposit or you do a average monthly deposit of a certain amount. As we mentioned in the call, we'll actually launch SoFi Plus, which will give you that higher rate for a fee per month, which will be quite attractive relative to the amount of interest you could gain when you pay that fee. In addition to that, we have the ability to do person-to-person payments to an email address or a phone number. We recently launched Zelle, which is very unique among the fintechs, which is a highly requested product.
In addition to that, we provide seamless capabilities into our brokerage business and money movement more broadly. So the APY is one important element of driving deposits, but it's the broader value proposition that we offer that we think will continue to allow us to drive strong deposit growth on the back of strong member growth in money.
Yeah, and what I would add to that is we've consistently said that we were going to add over $2 billion of member deposits each quarter. We certainly did that in Q1. We did it again in Q2 with $2.2 billion of net new deposits from a member perspective. We did pay down about $800 million of brokered CDs as they had higher costs relative to our member deposits. Right now, we are about just north of 80% deposit funded. Going forward, we believe the optimal mix is consistent with our prior guidance at about 80 to 90%. We still have about $1.1 billion of warehouse debt that's outstanding and nearly $2 billion of brokered deposits. So we're going to continue to optimize funding sources and lower our overall costs.
The next question comes from Reggie Smith from JP Morgan. Reggie, please go ahead. Your line is open.
Hey, good morning, and thanks for taking the question. I appreciate the disclosure on the loss curves, and I hope you guys continue to publish that. Kind of similar thing. I was curious, and I think I asked about this last quarter, about the credit card program or business. And I look at, the fact that you've got 4 million money users and, almost 4 million relay users, and only less than 300,000 credit card accounts. And it would seem that there's an opportunity to really be very targeted and slice and find really prime credits within your customer base. Can you talk a little bit about that? Maybe, am I oversimplifying that? It just seems like that business could be a lot bigger than it is. But maybe I just don't understand how that ramps up. So maybe a little color on how that business grows and some of the things that keep it from growing faster than it would appear to have the opportunity to grow.
Reggie, thank you for the question on credit card. I would start by saying, we have a pretty diversified portfolio of products. Our goal is to drive a series of S curves of growth across the products so that we drive strong, durable, diversified compounding growth for years, which means we'll invest in some businesses faster and quicker than others. I often say internally, we have some startup businesses, we have some Series A businesses, some late stage growth businesses, and some mature growth businesses. Credit card is one of those early stage businesses where we want to make sure that we get the marketing, the product market fit correct, the credit correct, and really the overall unit economics of our credit card on a per account basis correct. We've spent the last 18 months working our butt on that, and we feel like we have the right formula. I know we have the right team. We did change the team about a year and a half ago, bringing in someone that's actually built this business from scratch before, in addition to running businesses. So we have a very positive long-term outlook for credit card and want to contribute to our business. I often say businesses like credit card and brokerage by themselves someday could be bigger than SoFi is in total today. There are companies that are very big that are just in the credit card business and just in the brokerage business. And today, those are small for us and we're investing aggressively. We pointed out the fact that the brokerage business and the credit card business combined are annualizing a loss of $100 million. So what are the changes we're making in credit cards specifically? We'll launch 2 new cards. We'll be testing them slowly. One is an everyday card where people get a much higher percentage reward on categories like food or things that are used every day. The second card is more of a no frills, no surprises card for people that are in our ecosystem that are members, but they have thin credit files, not because they have low credit, they just have very little credit because they may be a new professional, in addition to our existing card. Not only will we launch 2 more cards, but we'll make those cards work better with our other products. So if you're a SoFi Plus member, your rewards will be boosted because of that relationship between SoFi Plus and credit card. So we can start to benefit from not just targeting our members, but giving our members more value for using more than one product. And you'll see us continue to do that over time. But in credit card today, we're going to continue to move relatively slowly and not step on the gas too hard, because this is a business you can lose a lot of money and you can lose it every day. It's unlike a loan where you give somebody a fixed amount. In credit card, you have lines that are quite big and they can be utilized in nefarious ways and drive really high losses. So we'll continue to make sure we approach this prudently, but we are stepping on the gas a little bit more than we have in the past.
The next question comes from Jeff Adelson from Morgan Stanley. Jeff, your line is open. Please go ahead.
Hey guys, thanks for taking my questions this morning. I just wanted to circle back on the lending growth. I know you're still sort of maintaining a more cautious stance on origination there. You did a little bit better than we thought on originations this quarter, and your lending revenue growth looks like it's still up 5% year over year. So I guess just, are you seeing better opportunities coming in the door, and does it have anything maybe to do with more certainty around the forward look with rate cuts? I know you're talking about potential increase in unemployment rate from here as well. So just trying to square all that. And then Chris, also just in terms of, the bending of the curve comments on credit, just wondering when you think that might translate into the, all in 5.4% charge-off rate starting to come in lower each quarter as well. Thanks, guys.
So in the lending business overall, our first objective is to make sure we continue to diversify the lending business relative to the total company. Less capital, less risky businesses get valued much higher. And we don't want to have an over-dependence on a high capital, high risk business. And this year, the macroeconomic environment accelerated our diversification, and it's worked out quite well. We also want to diversify within lending. As I mentioned, home equity loans is diversification into secured lending, which will be our second secured product. In addition to that, student loan refinancing is our oldest and used to be biggest product. We think is starting to come into a period where it can do quite well. And that's also diversification relative to unsecured personal loans. And then across home loan refinancing is also a vehicle. As we go through the year, I think it's important just to understand we're trying to manage to the overall growth of the company. We have so much resources we want to allocate, and we're allocating it to drive that outcome of diversified, less risky, less capital intensive businesses. If we wanted to grow personal loans more, we would have to allocate more capital to it. Why? We have to drive marketing that drives the top of the funnel that then drives conversion. Those loans don't just happen because we decide to actually underwrite more. We actually have to spend money to underwrite more. Right now, we're choosing to spend that money in different areas that don't drive as much revenue. But despite that trade-off, we're still driving 22% year-over-year revenue growth and a record despite barely growing personal loans. So it's a very conscious effort to diversify in a number of different ways. Diversification means you reallocate resources other places. If we reallocated to personal loans, we would not achieve our diversification. Now, what happened in the quarter? Our marketing costs were more efficient. The money we were spending was driving more demand than otherwise would have demanded or otherwise would have driven. And we took advantage of the higher unit economics to drive more volume against a set amount of resources in that area. We could be more aggressive if we choose to allocate more resources to lending. That could happen because we have upside in other businesses. That could happen because the marketing efficiency is greater than we anticipated, or the credit is performing better, or we sell more loans. And so it's not because the growth isn't there. It's how we're choosing to allocate the capital in this environment relative to our broader goals. And I'll let Chris talk about the specific question you had on the losses.
Yeah, and in terms of when some of these early DQ trends will start to show up in the NCOs, we're sticking with our overall guidance of being confident in the 7 to 8% life of loan losses, and we aren't guiding to NCO rates specifically. Reason for that is quite simple. The NCO rate is very lumpy. It's a function of a number of different factors, such as originations in the period, sales in the period, and most importantly, the average age or how much UPB remains on the portfolio, which can be driven by a number of things. So overall, we feel really confident in our life of loan loss expectation of 7 to 8%, but we're not guiding to NCOs because they're so lumpy.
Our test question today comes from Peter Christensen from Citigroup. Peter, your line is open. Please go ahead.
Thank you. Thanks for the question here. Good morning. Nice trends. I was wondering if you could talk about the appetite for future asset sales, either demand for it, but also your risk transfer strategy kind of going forward from here, given that you are seeing improvements, credit improvements in your portfolio, particularly in the personal loan portfolio. Just how are you thinking about risk transfer from here, and if there's further opportunities to de-risk the portfolio? Thank you.
Yep, absolutely. So overall, we're seeing continued strong demand from credit buyers. We've done $3.3 billion in sales over the course of the last 3 quarters in our personal loan business and 4.7 in aggregate. That's predominantly driven by the shape of the interest rate curve with lower expectations in the second half of this year, as well as the next several years. So we have very attractive yielding assets with very strong credit profiles and low risk for buyers. Essentially, buyers are looking into lock-in purchases and programs ahead of any interest rate cuts. In addition to that, we have a really strong balance sheet. We are able to offer flexible deal structures to meet buyers where they need to be. We are one of the few participants that can sell in size. It allows investors to put money to work. It allows buyers to have one buyer versus many, and it allows them to have a long-term partner versus doing bespoke one-off transactions that require a ton of work. Buyers want stability of asset generation. So looking forward, we expect to see continued strong demand from credit buyers. In a declining rate environment, we would expect that demand only to increase as those buyers would have lower cost of leverage. And again, we're one of the few folks that have a sizable balance sheet who can do that.
We'll take one more question, operator, and then I'll close with comments.
The final question comes from Tim Switzer from Stifel. Tim, your line is open. Please go ahead.
Hey, good morning. Thank you for taking my question. How would a return to a lower rate environment kind of change the ROE math you guys have talked about on choosing to retain loans versus selling? Do you believe it could strengthen demand at all in the secondary market and kind of change your balance sheet management at all?
I would say generally lower rates are going to make the loans more attractive to those without origination platforms that have assets they need to deploy. Our weighted average coupon is quite high, and that ROE becomes more attractive as rate environment declines and there's less places for them to find that type of yield. We've seen that in the past be the case. So we would anticipate more demand. We'd have to manage it relative to our production and our own financial goals. But I do believe the demand would increase and the terms would be more favorable and the values also, would be attractive. We have to wait and see that happen, but that's what we've seen in the past. Great. In closing, I want to express my gratitude to our team. Q2 was the most rewarding quarter and, dare I say, the most fun that I've had in some time at SoFi. What made it special and fun was that we challenged ourselves to be better in areas that are the most difficult in the current environment that aren't supposed to do well in this environment, such as home loans and student loan refinancing that had volume increases of 71% and 87% year over year. The team found a way to be better continuously throughout the entire quarter, not just each month or each week, but literally each day, finishing strong all the way through the tape when, quite frankly, the only reason was because we pushed ourselves to keep iterating. It was also fun because we made hard resource allocation decisions in 2023 that meant doing less than we wanted to in areas with great growth potential, such as invest in credit card, where we are now seeing promising results. Our invest business is accelerating with AUM up 58% on the back of a lot of hard work and only a couple of important areas and a testament that less can be more. In our credit card business, the immediate gains from all of our iteration aren't so large today, but with time and scale, they will be massive and well worth the patience. If you can't tell by now, I feel great. To put it bluntly, I do not know of any financial services company or fintech that has transformed their business to be less risky, less capital intensive, while still driving strong revenue growth, 40+% user growth, all while massively increasing profitability and still funding a rapid pace of innovation. When you take a step back, it's inspiring to see. We hit record revenue of nearly $600 million with 22% year-over-year growth, despite lending barely growing. We did that because we achieved record revenue in our financial services segment at $176 million, up 80% year-over-year, on the back of 47% year-over-year growth in products, 80% year-over-year growth in deposits, 58% year-over-year growth in AUM, and 67% year-over-year growth in interchange. In lending, we grew home loan volume 71% year-over-year, Student loan refinancing volume 87% year over year, and personal loan volume 12% year over year, while delinquencies declined on an absolute and percentage basis for PL, and we provided vintage analysis that clearly shows why we are comfortable with personal loan, life of loan loss forecasts. And finally, we grew EBITDA 80% year over year. I love what we have built, but more than ever, I love the people we are building it with and the gritty culture we have created. Hard is not for everyone, but for me and those who stay at SoFi, it fits just fine. Thank you for your interest in SoFi, and talk to you next quarter.
Oh my gosh.
Honestly, a mic drop moment. I love his closing remarks. That was
Tanner,
the
you're
best call
muted.
I've heard from him.
He's talking in all caps, man. That was so much fun.
Yeah, that's great.
Yeah, I think he wanted, like, I think he actually came with a plan to raise the energy a bit, but also delivering a great quarter. I honestly think, based on all the comments about lending, trying to answer those, them saying, you know what, like, things are going to severely have to change for us to hit 8% life alone losses. You know, the remaining amount of the unpaid principal will have to hit 11% net charge-off rates in order to just reach 8%. Like, they said, we've never even seen that. And Chris Lapointe literally said, we are on the other side of the peak. He said, we've surpassed that peak of losses, Chris. I'm sure that got the hairs on your arms tingling.
Yep. No, that was awesome. Like, that was the best SoFi earnings call I think they've ever had. They really brought it.
Yeah.
Still would have loved more disclosure on the tech platform, right? Like, that's the one nitpicky thing that we didn't get. But man, like, there were so many shots fired in there. That was awesome.
In terms of price targets from analysts, who can hold it down to where they've held it? You know,
Well, I mean, the EPS for next quarter is supposed to be 4 cents now, right? They've already had 2 cents and 1 cent, and the full year expected is 8 cents, right? How can you can't look at that and not, like, I think we're going to see upward revisions from analysts. Like, I can't imagine. You have to, right? Like,
yeah. And I think that this is the one thing that I want to keep harping on is, okay, we watched the stock not really move. We watched the stock not really move. Analysts right now are expecting 43 cents for 2026. If they continue to come out being conservative while triple beating, they will dominate those estimates, absolutely crush them. Okay. And the stock is going to see some re-rating, and there has been time and time again where companies that are misunderstood get repriced, and stocks that were sometimes sitting at $9 go to $20+ because people are now re-understanding the level of growth that they can bring. Okay. I really think he's listening to a lot of retail there. He was trying to answer a lot of the product innovation questions, a lot of what they've been working on, answering some questions about SoFi Invest. It was really interesting. New credit cards, people. Tevis was 100% right. They announced the products midway through the call.
Yeah, PR is going to drop later today, probably.
And the SoFi Plus subscription.
Yeah, that was great. Yeah, so I mean, like, what more can you expect off of this call? Like, they triple beat. They issued an insane guidance for Q3. They dropped new product lines. Like, they reiterate everything, and they basically mic dropped on the call. They cut off like half the questions from. Like, I was joking around with my chat. I was like, can't wait for Giuliano to ask his question. Guess he didn't, have a chance. He was waiting on the call probably. Like, they're not mincing words anymore. They're not beating around the bush. They know their hand, and they're not afraid to, speak to that. So from a confidence level, like, I really want to see, and I'd love to see the executive team, actually having that confidence in terms of what the results are and being able to back up their numbers. So it was a great call for me. Much, much, much better than Q1.
I'm interested in hearing about more of this, going after credit cards with people with less credit history. Obviously, they get to see if they're going to give these credit cards out to people with SoFi Money accounts, SoFi Relay, getting a better picture of them without seeing FICOs, it'll be really interesting how that performs. And Tevis, you pointed out exactly my thoughts in the comment section, which was this seems like a direct comment towards Robinhood saying like, hey, you can lose a crap ton on credit cards. It's not just about offering something. You actually have to perform on it. So we're going to take it slow, but yeah, it's very interesting.
That was such a good call. I feel like they're trying to, they're like demanding respect. They're still not getting it. But like, I don't know if they're going to get it in the near future, but like I was really impressed. Oh, I'm wearing my SoFi shirt, by the way.
So those net charge-offs, the bearish analysts at KBW expected 6.7%. We got 5.4.
Yeah. So 5.4 if it were adjusted. It was actually down below 4%. Like because once again they sold off some, delinquent loans, which is fine.
Right.
They're getting more. Like it makes sense to do that.
It made
But
more than what they were going to make if they held them.
But 5.4% is really low. Now, part of what helps that is the fact that they originated 4 billion instead of 3 billion, because you're not going to get, those aren't going to get charged off. But that's only like, even accounting for that, the net charge-offs were way lower than what like the KBW analyst would have. Again, the tech platform, we need more there if we want to get like if we want to fire on all cylinders. But every other cylinder, all of the B2C stuff, like all the consumer facing stuff, is just, it's excellent. That was so good.
Did they say that they got I mean, it'll be better whenever I get the transcript, but that they got 106.2% gain on sale margin from selling some personal loans?
Yeah, that's the highest gain on sale margin they've ever had. The highest was last quarter at 105.9. They got 106.2.
That's before rate cuts.
Yep.
So Anthony Noto is going to be on CNBC in about 20 minutes, right at market open at 9:30.
Okay. Perfect.
Dang.
There was
I need
another.
to write down that final statement, man. That was so good.
Yeah, I'll probably clip it and throw it up on X.
He said something along the lines, I paraphrase him, but he said something along the line, or Chris Lapointe, I think, said, loan buyers want stability and income generation. We expect this demand to only increase. We believe we are among very few names with a balance sheet to match this growing demand. Like, I'm really getting incredibly excited about how they're going to operate in an environment where rates get cut every, couple meetings or so, like in that downwards trajectory. I think SoFi being so conservative is going to absolutely pop. Very exciting. I feel bad for the people who were talking so much crap in this company in the comments even today. Good luck to you. But I'm going to continue to hold my shares. I'm a very happy SoFi shareholder.
Likewise. That was awesome. I know you want to get to PayPal.
Tevis, any last words?
I gotta go to work, man. But yeah, I mean, once the transcript comes out, we're going to be diving into the numbers more specifically. But from a sentiment perspective, this was 10 out of 10. Everything you want to hear. I mean, if we had to rate this earnings like a number out of 10, I think my score would be like, let's say 9, simply because the tech platform could have been a little bit better. But relative to everything else, like the life of loan losses, all the lending side, the financial services, the guidance, the sentiment on the call, I think, 9 out of 10 is, or 9.5 out of 10, probably one of the best earnings calls that I've ever heard from them. And if people are still talking shit about SoFi in terms of, oh, well, the bear case is this or that, like, I think Danny Dios on the chat was saying, like, there is no bear case anymore. Like, you tell me what the bear case is at this point. I think they've completely broken through. And especially because the second half of the year is going to be even stronger. And it's going to lead to upward revisions, like Chris said. It's going to lead to a complete repricing of this company. And I'm here for it. Like, this was the quarter where I was most concerned throughout the rest of the year, and they absolutely smashed it. So rest of the year is smooth sailing for all I'm concerned.
Ladies and gentlemen, thank you all so much for watching. We're going to continue to have SoFi Weekly things go over all this. You'll see videos from Tevis and myself, articles from Chris to cover everything that has happened this quarter. But I'm going to go review PayPal. The stock is up dramatically, and I can't wait to listen to the earnings call. Thank you all so much for watching. Really appreciate your time.
Thanks, everyone.